Let's now turn to real estate with a focus on commercial and perhaps a smart way to invest there. Matthew Strotton joins us from Real Asset Management, Head of Funds Management for the real estate division there. Matthew, welcome to ausbiz. Good to have you on the show.
Morning, Andrew.
So,
Great to be here.
how would you describe those opportunities in commercial real estate at the moment, given obviously the difficulties we've seen, particularly, I guess, in office and retail?
Yeah, it's a great question. We've been talking about this at length within the group and in preparation for today. It's a great time to sort of contemplate that particular question. I think where we are is at a moment in time where we're reaching a point of normalisation. Most investors would have seen the All Property Index data that's been published by MSCI has reached the first positive annualised return since 23. I think where we are genuinely at today is that investors have experienced a sustained period of volatility, and we all know those reasons. We've coming into a very long and sustained and inward cycle on rates, at which point we experienced COVID, and then we've seen a range of behavioural and financial conditions unwind into a very, very short and sharp interest rate cycle. So investors have experienced a significant and sustained period of volatility in real estate. Are we now at a point where returns are normalising, or our assets are being priced on fundamentals? We're at a point where financial conditions are more of a level playing field so people can make more reliable and due diligence-based decisions into real estate. And I think that's where we're at the moment. The relative value, a question at the moment for commercial real estate, it's a very good question. I think it is a great time for investors to go back to really understanding the fundamentals of real estate and where they might be considering making sustained commitments into the space. And as I said, it's an opportunity to do that at a point in time where the outlook has moved towards a more favourable set of conditions, particularly as we look ahead for interest rates. And as I said, we can now participate in opportunities where we can price assets on fundamentals.
So, Matthew, if we break this down into sectors, and bearing in mind obviously the difficulty in that space given where interest rates have been, now of course that has turned given we're now into the easing cycle. What are you liking specifically? Now, industrial has been very resilient over that period, whereas we have seen office and retail struggle. Are you seeing that turnaround now?
Yeah, I think retail, and perhaps not all retail. I think the relative value in perhaps super regional and regional malls has been identified by those first moving investors back in this particular cycle. I think neighbourhood retail is going to remain, or should remain, on investors' horizons because of the long-term sustained and low volatility nature of income that is derived from neighbourhood retail. I think some other features of retail and some other asset classes, perhaps not industrial, as you say, has been the supply equation. Coming through the end of the cycle in sort of 2020, 21, and then experiencing COVID, it's not surprising to hear that retail, certainly the office sector and healthcare for that matter, have had a sustained period where the supply of new space, building of new space, or adding value to existing real estate space has declined or has reduced below trend levels for quite a period of time. And the need for new space in those sectors is going to, at some point, go back to a level of normalisation or potentially trend higher. And I think that's where exposures in those particular sectors is going to prove to be quite attractive, again, because it's being priced on fundamentals.
And are you seeing pockets of distress there that are perhaps providing that price opportunity?
Yeah, it's a great question. I'd normally be perhaps a little bit more on the front foot on this one. I think distress value at the moment is a little bit more difficult. I think investors really do need to undertake a far greater level of diligence when they're looking at opportunities. I think the one area I would call out is in listed markets, portfolios and listed portfolios being appropriately priced at the moment. Certain operators being potentially overpunished for current levels of debt, current levels of potential value add exposure, and underlying values being appropriately set, having regard for the recent publishing of the All Property Index compared to where returns are sitting, and having regard for what is going to be an increased level of demand coming into the sector. I think taking a close look at individual listed opportunities across all sectors would be a worthwhile review for most investors if they're going to look for distressed value.
Matthew, you talk about listed. How do we compare that with unlisted then real estate? I guess you take a look at the pros and cons there.
That's a great debate. That's been a debate for many, many years. I think listed markets tend to suffer more volatility by external factors. That's quite an obvious one. And they are naturally priced almost on a day-to-day, minute-by-minute window, whereas unlisted opportunities tend to flow through almost on a quarter-by-quarter basis, where valuations that are conducted on an external basis are prepared and investors are reported on the progress of their particular exposures in unlisted. So you don't necessarily see the same level of volatility in unlisted that you do see in listed markets. I think at the moment that the relative comparison is getting closer and is more rational between the two, because pricing, as I said, I feel has reached a level of normalization where investors can have greater faith in underlying values and price new opportunities on fundamentals alone. Having said that, is there still value, as we spoke about before, in certain sectors and in certain listed exposures? Yeah, I think there is, but investors really need to do an extra level of diligence at the moment.
Yeah, you did cover retail. What's your view then on office at the moment, given what we're seeing particularly in the capitals?
Yeah, I think the office sector is still subject to shifts in behaviour, and that is not a nationwide phenomenon. I think each capital market in terms of urban exposure in office still has a level of variability in the level of work from home that is still being adopted by corporates, by governments, and how that has flowed through to the sustained demand for listed space is not parallel across all markets. Again, I sort of step back in office markets and look back at what has been a sustained level of undersupply of space. Some markets are different. I mean, Brisbane has been an extraordinary story, and I think will still be an extraordinary story as we experience the next sort of 5-10 years of growth in the region. But markets have already suffered and experienced that level of volatility that has flown through from the post-COVID behavioural phenomenon and working phenomenon. Markets now sort of moving back towards a new norm in terms of working from home. Yes, I think we are, but not all markets are doing that the same. I think that the best way to underwrite office opportunities is just how well individual assets are placed within their local submarkets and what has been the level of supply that might impact on demand, and can you then price opportunities based on those fundamentals, and how does that pricing compared to, for example, the MSCI All Property Index, and how are yields stacking up?